This is Carl with the three things I'm watching for Tuesday, July the 22nd. Starting out weekly crop ratings, not quite as good, maybe. I don't know how to say it. Corn, 74% good to excellent. As trade expected, didn't improve on the week at all. Soybeans came in 68% good to excellent, down 2 points on the week. Trade is expecting a 1 point improvement. Spring wheat, 52% good to excellent, down 2% on the week. Trade was expecting a slight improvement there as well. Not that it's a big factor, but one thing that it's just minimal, but it jumped out at me in the whole report is that the poor, very poor rating on corn was up 1%. I realize it's not a big factor at all, but it still tells you that yes, this crop is not perfect, and it's 1%. It's not a huge volume. But when you look at the rest of the ratings, you have to ask yourself, is corn really going to be able to hold in at this high rating if everything else starts to deteriorate? So, a few questions raised after the ratings come out. But the bottom line is, even though they declined on soybeans and wheat, not enough to really shake the market up here. A little bit of pressure overnight, not too surprising. Second thing I'm going to be watching today, the NASDAQ 100. For the past 60 days, and I shared this on Twitter yesterday and in last night's comments, but the NASDAQ 100 has been trading above the 20-day moving average for 60 days now. If you look at the chart, it's pretty much a straight rally. If you look at a 60-day corn chart, it's just the opposite. And that's a to me that's a little bit of a verification. We've been talking about how the managed money crowd just isn't interested in commodities, and their lack of buying interest has been one of the most negative factors for the complex right now. Even if we get bullish news, we can't sustain a rally because we just don't have the managed money buying in the complex. So, not a big deal, but it tells us that the Nasdaq is where a lot of the money was going that was coming into commodities, and also Nasdaq's starting to get maybe a little bit overvalued. So we could see some of that money come back. But anyway, that was a pretty interesting signal, I thought. And the third and final thing, watching Packers throughout the Midwest, many of them have slowed up their slaughter runs down to the bare minimum allowed by union contracts. Packers have to maintain a certain volume according to their contract negotiations with the unions. Most of them are there. They don't want to buy this high-priced cattle and process it and then end up getting a retailer that pushes back on the high-priced product. I see this continuing for a bit. Cattle rallied hard on the news yesterday. Also, replacements, it's the same story there. All-time highs in the cattle contracts. We just have a tight cash market and tight inventory. But we do have a consumer that for now continues to stand there and buy high-priced beef, which is good. As long as we can get that to continue, the complex should hold in there. Hogs, a little bit of pressure could be coming from hogs. That Chinese hog herd bigger than we thought. I would expect to see some culling there. Government sponsored culling, maybe, is how we would call it, to get their hog industry back into a declining mode. Those are the three things I'm watching today.